From 1st April 2026, India's income tax system, a framework that has existed for more than 60 years, is not just amended, it is completely re-engineered. 536 sections, a 976-page rulebook, a new concept called tax year. But here is the real question. Has the law become simpler or has it become more powerful? Because today, tax is not just about what you earn. It is about what the system can see. In this video, I'll explain when the Income Tax Act 2025 comes into force, what major structural changes are introduced, how the Income Tax Rule 2026 impact compliance, and what this means for salary, TCS, and importantly, crypto, virtual digital assets. Hi, I'm Subrahmanya, advocate and tax consultant. I deal with taxation, compliance, and litigation. Let us break this down practically and powerfully. Let us see the timeline first. The Income Tax Act 2025 was approved in the year 2025 itself. Implementation happens through rules, notification, and system level integration. Now, the Income Tax Rules 2026 are notified. This completes the legal framework. Effective from April 1st, 2026 itself. Remember, Act creates the law. Rules activates the law. What is the structural shift happening? Earlier law, that is the present law, existing law till 31/3/26. Okay, 800 plus sections and complex numbering system due to many changes in between. Now, 536 sections and clean structure. But this is not simplification. This is restructuring for control. Sequential numbering, logical grouping, better readability, etc. Easier to read, but harder to escape compliance. What is this new tax year? That is tax year. In the old system, there were previous year and assessment year. In the new system, tax year has come into effect. Income taxed in the same year. Confusion reduced, compliance responsibility remains. Now for salaried classes, what is the allowances? For children education, 3,000 per month per child from 100 rupees. For hostel, 9,000 per child per month. Meals, 200 rupees per meal from 50 rupees. Gifts, 15,000 from 5,000. EV perquisites. Expanded tax-free commuting now. 5,000 per month if employer bear the cost. 2,000 per month if employee bear the cost. Additional 3,000 for chauffeur. Now, EV becomes a tax-efficient salary component. What about how HRA, house rent allowance? For claiming HRA at 50% category, now includes Bengaluru, Hyderabad, Pune, Ahmedabad. But Noida, Gurugram, Navi Mumbai still at 40%. This leads to tax disparity. TCS and tax flow. Let us see a TCS and tax flow. Foreign remittances above 10 lakh for educational and medical purpose, 2% TCS. Overseas tours, again 2%. Earlier slave system completely removed. STT for trading derivative increase. Now trading cost rises now. Crypto. Let us see the core tax structure. What is crypto taxation? 30% flat tax. 30% tax plus cess plus surcharge. No short term or long term distinction. Now, what is transfer in VDA crypto? What is the transfer now? Tax applies when you sell crypto in INR. Convert crypto, BTC to ETH, that is Bitcoin to Ethereum, or use crypto for purchase. See, crypto has got two benefits. One is investment and another is purchase. What are the other restrictions? 1% TDS on transaction, no carry forward of losses, no deduction except cost. Meaning, every transaction is taxable. Losses are ignored. Liquidity gets blocked. Reporting framework. Crypto, CBDCs, they are reportable accounts now, aligned with global compliance systems. Government visibility is now deep and structured. Let us see the advanced crypto framework basically. Now this is where complexity begins. DeFi taxation, that is tax on decentralized finance without intermediary, peer-to-peer. Even without exchange, tax still applies. Yield farming, liquidity mining, taxed at slab rate when received. DEX swaps, okay, direct exchange. Treated as transfer, 30% tax plus 1% TDS. Borrowings, not taxable. Collateral liquidation, yes, it is taxable. TDS on direct exchange, that is DEX, may not auto deduct. Voluntarily you have to declare. Mining timing. Mined crypto becomes taxable, taxed at receipt stage only. Classification as business income. Value is equal to fair market value at receipt. When you sell it later, 30% tax on profit. Sale is minus fair market value. Staking classification, nature of rewards. Treated as income from other sources. Taxed at slab rate at time of wallet transfer. Later when you sell, 30% tax applies. Foreign exchange, FEMA regulations overlap. Cross-border crypto. Crypto treated as asset, basically, as a property. The key risk is foreign exchange holdings. When you hold it in foreign exchange, must disclose in schedule foreign asset. Non-disclosure become black money. There is a black money act risk. Cross-border crypto, FEMA applies. Using stable coins and bypassing the banks, it's a violation. Penalty is 3 times the amount involved. See, the words like DeFi, stablecoin, DEX might sound some little technical. No worries. Please comment. I'll explain it. Crypto is not just taxation. It is tax plus compliance plus regulatory risk confirmed. And that is why tax exists, but clarity does not. The compliance revolution is no major taxes, but massive expansion in tracking, digital reporting, AI scrutiny, data analytics, audit trials. System-driven taxation begins now. For business and trust, there is a transfer pricing benefits, expanded safe harbor, that is for lithium battery and these kind of industries. But early filing is required and defined thresholds. For charitable trust, single application system, centralized processing, record reduced to 6 years. Simpler process, tighter control. There are some areas still unclear, such as crypto classification, DeFi ecosystem, FEMA overlap, that is foreign exchange. So, has the law become simpler? Yes, structurally, but in reality, it has become powerful. Sections have reduced, but control has increased. Law is no longer what is written. Law is what is tracked. Follow me for more practical tax insights. In the next video, we will discuss real life case analysis under the new income tax system. Thank you for watching.